Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, May 8. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. After hiking rates last week for the 10th consecutive time, the Federal Reserve hinted it would probably pause in June. But in the meantime, we're starting to feel the harsh economic effects of tightening. Will the pause come too late? In the span of about a year, the central bank has hiked rates by more than 5%. Fed Chair Jerome Powell intimated at his press conference last Wednesday that a pause may be in the offing at the next meeting in June of the Federal Open Market Committee, the FOMC. A pause is what Wall Street wants. However, the recessionary consequences of tightening already are in the pipeline. Higher rates exert lagging effects, and in its zeal to contain inflation, the Fed may have tightened too far for too long. The real economy is taking a hit. Witness the turmoil in the banking system with multiple regional bank failures. At the same time, lending conditions are getting tougher, manufacturing activity is weakening, and the housing sector is slumping. Senior loan officers are reporting tougher credit standards, as you can see from this chart. The more the Fed increases the interest rate, the tougher it is to get credit. Businesses and consumers will increasingly pull back. They already are. Odds of a recession have increased, although it's likely to be mild at worst. The labor market has remained surprisingly resilient, which should help keep the economy from a harsh downturn. In the meantime, the main U.S. and overseas indices finished last week lower, except for the tech-heavy NASDAQ, which managed to eke out a slight gain. The Dow Jones Industrial Average fell 1.2%, the S&P 500 fell 0.8%, the NASDAQ gained 0.1%, and the MSCI EAFE fell 0.6%. The EAFE is an index of mid and large cap equities across 21 developed countries, except the U.S. and Canada. The benchmark 10-year Treasury yield finished flat, and crude oil prices declined by more than 7%. Jerome Powell did not explicitly say last week that the Fed was poised to pause rates, but some of the language in the Fed statement suggested, ever so faintly, that a pause may be in store for next month. The FOMC statement deleted the pre-existing phrase, "some additional policy firming may be appropriate," and swapped it with language that it would assess incoming data to determine the extent to which additional tightening would be appropriate. You know, Fed watchers are akin to Kremlinologists. They parse Fed speak for every nuance. The interpretation here is that the Fed no longer assumed that further rate increases were appropriate. Nonetheless, the additional 0.25% hike, combined with downbeat economic data and Powell's hawkish dismissal of any rate cut this year, took their toll on stocks. So did further banking uncertainty, as failed First Republic Bank got gobbled up by J.P. Morgan Chase, and other troubled banks came under scrutiny. The swoon in stocks would have been worse if not for better-than-expected corporate earnings. For Q1 2023, the blended earnings decline for the S&P 500 is minus 2.2%. That's a big improvement from previous estimates. On March 31, the estimated earnings decline for Q1 2023 was minus 6.7%. For Q1 2023, with 85% of S&P 500 companies reporting actual results, 79% of companies have reported a positive earnings surprise, and 75% have reported a positive revenue surprise. Apple, in particular, gave the overall market a jolt of adrenaline last week. The company beat analysts' expectations on the top and bottom lines for its fiscal second quarter. Revenue was $94.8 billion versus $92.6 billion expected. Adjusted EPS came in at $1.52 versus $1.43 expected. And iPhone sales reached $51.3 billion versus $48.9 billion expected. Apple continues to dominate the smartphone market, reaping an estimated 82% of operating profit share from the global market in the first quarter of 2023. The Cupertino giant is considered an economic bellwether. The company didn't provide full-year guidance, a practice that started with the pandemic in 2020. However, its fiscal Q2 report card, released after the closing bell Thursday, helped spark a sharp equity rally on Friday. Now let's take a look at the week ahead. Here are the salient economic reports scheduled for release this week. Wholesale inventories Monday, Consumer Price Index Wednesday, Producer Price Index and initial jobless claims Thursday. Consumer sentiment Friday. The inflation data will be the biggest news this week, of course. We've enjoyed a healthy rally so far this year, albeit dominated by a handful of mega-cap leaders. Volatility is likely to increase, and the bear market, well, it's still with us. But as the year progresses, opportunities will emerge as more bullish conditions take hold. Amid the uncertain conditions I've just described, are you looking for the next big growth opportunity? Consider the green rush in marijuana. Marijuana poses huge investment opportunities, but you need to be careful. That's why I wrote a book, The Wide World of Weed and Psychedelics. My book is your definitive guide for safely making money in the thriving cannabis and psychedelics industries. To get your hard copy of my book delivered right to your door, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. And if you have any comments or feedback, please send an email to me at mailbag@investingdaily.com. Well, that's it for now. Thanks for watching.